The average investor is missing out on 50% greater gains, not because of technical ability or knowledge, but because of psychology. There are 9 tricks that our mind plays on us that causes us to screw up our investments. The first principle that causes us to make poor investing decisions is mental accounting. Imagine you're at the casino and you brought $100 for the trip. That's your bankroll. Once that $100 is out, you're done gambling. So you start with a cheap slot machine and you get lucky right off the bat. You pull, and now you're up to $200. Mental accounting is where you see that $100 profit as fundamentally different than the $100 that you brought with you on the trip. Your $100 profit, you might feel like you can be overly risky with it because you're playing with house money. Meanwhile, with your $100 that you brought, you might act more responsible and make more conservative betting plays. Treating the two Benjamins as different entities and different amounts of risk is mental accounting. In reality, these two Benjamins are identical and should be treated that way. Mental accounting causes investors to make irrational investments into overly or underly, is that a word? Risky investments. The second principle that causes investors to sell too early is loss aversion. When the stock market starts to drop, panic selling begins and investors run out of the market. Even though during stock market crashes, this is historically the best time to invest. As humans, we naturally fear losing much more than the joy we experience from an equivalent gain. I will never forget the time that I lost a $100 bill out of my pocket. I received it in one of my paychecks as a little Christmas bonus. I had no idea it was coming. It was a complete surprise, and I was stoked when I got it, but that was nothing compared to the agony that I felt when I reached into my pocket where I left it and it wasn't there. I completely just lost a $100 bill. The pain was 100 times the joy. This graph shows investor behavior during the stock market for the crashes of 2000 and 2008. The red line represents the stock market price. You can see this first crash here, we go up, and then for that gray line, there's the crash, and then the second crash is at the second gray line. The blue line represents how much money investors are pulling out of the market. So as the blue line goes up, more money is fleeing from the stock market. Notice how the very peak, the top of the blue line, where investors have pulled the most money out of the stock market, is directly in line with the very bottom of the market in both cases. The most money comes out at the very bottom, even though this is the exact opposite of what it should be. Investors should be putting the most money into the stock market as the prices reach their cheapest point. The very bottom is the best place to buy, but investors just cannot bring themselves to do it because of loss aversion. The third principle that causes investors to make poor investing decisions is narrow framing. I love steak. Whenever I go buy groceries, you can probably find me drooling over the Wagyu. If I could afford it, I would buy, or at least I'd be tempted to buy nothing but A5 Wagyu every single time for all my groceries. However, this would not be a good idea in the context of my diet. Eating A5 Wagyu steak all day, every day would probably not end up tasting good in the end on top of that. The same is true with investing. My favorite type of investing is analyzing individual stocks that are higher risk and higher reward. However, my overall portfolio probably could not survive that strategy for long if that's all I did. I probably need some cash for emergencies. I probably need to invest in index funds in my 401k. And at some point, when I get older, I'll probably need to invest in some fixed income assets. Even though investing in individual stocks is my favorite, I need to widen my frame and keep into account my full portfolio. The fourth principle that gives investors false confidence is diversification.
This is where we take a bunch of Bs, double Bs, and triple Bs that haven't sold, and we put them in a pile. And when the pile gets large enough, the whole thing is suddenly considered diversified. And then the whores at the rating agency give it a 92, 93% AAA rating. No questions asked.
Just because you are invested in many different assets does not necessarily mean that you are diversified. Lumping together many assets that are highly correlated or are highly risky is a great way to set yourself up for devastating losses. This is exactly what happened to banks during the 2008 financial crisis. Improper diversification sets investors up for crushing losses. The fifth principle that keeps investors from selling out of a poor investment is anchoring. I have 100% been guilty of this psychological bias. Whenever I buy into a stock, I hate to sell that stock unless it is at least back up to the price at which I purchased it. However, the purchase price has no relevance on whether or not that stock is at a good price at the moment. Whenever investors are deciding whether or not they're going to buy my shares of stock, they're thinking about many things. They might be looking at the profitability of the company, the quality of their product, maybe the economy as a whole. But you know what they're not considering at all? The price that I bought is irrelevant when I'm deciding whether or not I should sell a given investment. For instance, if I bought my house for $250K and then the next day construction begins on a waste processing plant next door, that would suck. It would be incredibly unlikely for me to be able to sell that house for $250K at that point. So if I receive an offer for $230K and I reject it because I'm just laser focused on, no, I have to get out for $250K, then I would be committing to anchoring, making my selling decision based on an irrelevant data point. The sixth principle causing investors to make irrational investing decisions is media response. The media is incentivized to hold our attention. Therefore, the most sensational stories will naturally rise to the top, even though another year of typical stock market returns is probably the most likely scenario. Check out this graph showing the S&P 500 over a 50-year period going back to 1970. There are only 11 years in total where you lost money during that time. At the same time, there were 21 years where people made more than 20%. There's only 3 years where people lost between 10 and 20%. And there are 14 years where people made between 10 and 20%. Therefore, most media coverage will point you in the exact opposite direction. If I'm being swayed by TikTok influencers talking about the next market crash, then I will be pulling my money out of the stock market way too often and leaving gains on the table. Alternatively, if I'm looking at Wall Street bets and the riskiest stocks are being hyped up and then I run into those investments, well, then I will be setting my portfolio up for devastation. The seventh principle making investors hold on to a bad investment is regret. Today, this is better described as FOMO, the fear of missing out. At the most basic level, there are two types of mistakes that you can make: active mistakes and passive mistakes. An active mistake is where you actively make a bad decision. A passive mistake is where you don't do anything at all, but you fail to make a really good decision. Whenever investors are experiencing FOMO, they're being pushed into making an active mistake because they are overly afraid of making the passive mistake. Even though active mistakes generally cause much more damage to your portfolio. Falling for the regret principle often has investors staying in a bad investment or continuing to funnel more and more money in because they do not want to miss out on the rise in stock price or the recovery of their bad investment. The eighth principle, which causes investors to buy and sell at the wrong time, is herding. As mammals, we were evolved to run with the herd. If I see 10 people running for their lives, I'm gonna run too. And it makes sense. In the jungle, that strategy works. If I see 10 people running and I don't run, and it turns out they're running from a lion, the downside is I'm dead. If those 10 people are running and then I do decide to run and it turns out they were mistaken, it was just a squirrel in a bush making some noise, then the downside is I got some extra exercise. Herding mentality works for the jungle because it keeps us alive, but we did not evolve to have the best investing practices. When you run out of the stock market, there is a huge opportunity cost. Following the herd out of the market or into an overly hyped stock will hurt our investment returns or devastate our portfolio. The ninth principle that causes investors to make overly risky investments or stay in bad investments is optimism. When I'm on vacation, the rental car company always tries to get me to pay for insurance. What a scam. I don't need insurance. I'm a good driver. I'm only gonna be there for a week. Yeah, right. In this example, I'm being overly optimistic. I may be a good driver, but there are 1,000 other drivers on the road. I'm gonna be in an unfamiliar location. It's probably best that I get the insurance. Overly optimistic investors have rose-tinted glasses on and they are blind to the huge risks that may be lurking in different investments. The external risks that are out of my control do not disappear just because I am the one involved in an investment. If you have already been hit by one of these biases and you're sitting on a stop loss, do not fear. There is a way to get out and get something out of it. Check out this video where I go over the best practices for exiting a bad position. Catch you on the flip side.